What's going on, guys? Welcome to the New Equity Connections podcast. This is your host, Ian Starkey. Today I'm hanging out with a really good friend of mine and really high-level guy, Jad. So tell you a little bit about Jad. He has currently his own brokerage, his own property management company, his own cabinet wholesaler he's going to tell me a little bit more about. And he also owns 2 apartment complexes, all at the age of 26. This guy's a stud. So, Jad, I want to pass the mic off to you metaphorically. Tell these people a little about what you got going on.
Ian, what's up, my man? First off, thanks for having me. We always have a good time. Love chatting, love talking real estate and business in general, and talking high level. Good stuff, man. I'm out of the Cleveland market. We're primarily in the real estate space. We are, I've got a brokerage firm up in the Cleveland market, property management company, a construction division. You mentioned cabinets. We're launching a cabinet division that kind of supplies some of our flips and some of our apartments and rentals. We do syndications. We're opening a fund for real estate investments, and we just keep scaling up. We're excited about what we're doing. We're all about real estate. We're all about long-term holds. We do have some short-term businesses. We've got a flipping business here in Cleveland where, we're taking out properties for 2 to 3 months. We're reselling them on the market, but the gist and the majority of our business is long-term real estate investments in the management company. So that's what we do out of Cleveland. It's for us, it's been one of the most exciting things to do, and I can't see myself doing anything else.
Absolutely, and crushing it, man. You're crushing it, by the way. I think I said that already, but I'm going to emphasize it. So right now, managing company, own real estate. Let's talk about the fund a little bit. Tell me about the fund. What's going to be the structure of it? What kind of deals it going to invest into? What kind of returns are the investors going to expect from that?
Yeah, absolutely, man. So the fund's in the works right now. We're starting to, dissect more and more on the acquisition side. And so we're looking to launch the fund to be able to deploy more capital in these deals as they come through. The fund is essentially specific to multifamily value add properties, right? So we take down value add projects, multifamily, typically 60 plus units, many that are 100 plus. And this is large enough to have on-site management. This is typically something we're buying at 60, 70 cents on the dollar, when it's stabilized. And then we're completing renovations, we're being on the ground, we're improving management, cutting expenses where we can, and then exiting through some sort of refinance or a sale. And so the fund is going to be essentially the capital backing for all the ventures. And it's really going to entail a lot of multifamily. It's going to be in the mix of, Midwest, Southeast, some Southwest as well. We're doing a bunch in Texas. Texas is really hot right now. I know that's your backyard. And so the fund is really to deploy capital in really undervalued and high upside deals that we're finding.
Yeah, you're looking for deals. You're looking for those you don't know. So when we say the words value add, high upside, we're looking at apartment complexes, commercial size apartment complexes, which is 5 units up, by definition. But we're looking at stuff that's 100 units plus, 80, 100 units plus. So anywhere from 100 to 200 units. And when we say value add, for those who don't know, that's a property that's usually aesthetically kind of rough looking. Could probably use a paint job, potentially a new parking lot, kind of a little bit of cosmetic facelift and also interior facelift, whether that be fixing the foundation, doing some new plumbing, or just getting the manager out there that is really mean to everybody and putting someone nice in there that smiles and is nice to the tenants. So value add, it's a really good opportunity for people to make a lot of money in real estate. A lot of money from creating that value, but then also continue to receive the passive income from the rent roll as well as tax benefits. The city and most cities and states actually will give you a break if you're improving property. So that's a whole different rabbit hole we can dive down another time. But for this fund, so help me understand, is it going to be a general fund that's 20% operator, 80% investor, or 50-50? I mean, what's the makings of the fund, or have you gotten that far with it?
No, so it's essentially just the deployment of the capital into the fund, and the fund is 100% owned by the investors, right? Our sort of side of it, our piece of it is in the deal itself, and so our fund is essentially helping us fund more of our own deals, and so it's a partnership between us and the investors. As we take down more and more deals, we're able to utilize the fund to, whether it's make faster decisions on acquisitions, whether it's capitalize sooner, or whether it's avoid having like a tight deadline of say 30 days to bring capital together. We're looking to put the fund together to have all the capital so that it's ready to be deployed as the opportunities come up. And so the fund in itself is 100% to the investors. We're not taking management fees. We're not taking anything on the fund. Each individual property or deal would have some sort of structure in and of itself. But from the fund standpoint, it's always investor first. Now, when it comes to the deals, it's a mix. We've got some stuff that is like more standard syndication where it's like a 70-30 split in favor of the investors. We've got other stuff that are much heavier lifts where there's much more meat on the bone in the deal. And it's something that supports really high returns, even if we do retain majority of the equity. And so there are some deals where it's 80% operator, 20% investor, right? But we're typically shooting for double digits yield. Most of our opportunities, we're typically offering some sort of double digit pref return plus equity in the deals. And so what that does is, our hopes is to be 20% plus on the IRR side. And if that's the case, we're able to hit our numbers and we're able to keep our investors happy. So that's the gist of it. The fund is like 100% investors. Each individual opportunity and deal will kind of be based off of how much, I would say, equity and value add is available in that deal. Will determine how much the structure and how much, whether it's on the operator side, whether it's on the investor or the fund side, what kind of splits are in place at that point.
Okay, so the fund is going to be, I think so. The goal of the fund is to serve as normally whenever you or I buy a deal, we'll put it under contract. Either the general partners will usually bring their earnest money, we'll bring all the due diligence money, and then we'll create a 506c fund, a specific fund for that deal. So instead of doing that, this fund will come in as any LP equity, due diligence money. It'll just come in as that. So it allows you to also be more aggressive, doesn't it, on your offers?
It does. More aggressive on the offers and much more comfortable knowing we are ready to close because we have capital already ready to be deployed. And so we're not waiting till, say, 60 days into the contract once we finish due diligence and we've gotten some sort of approvals from lenders. And then we start the capital raise. We typically have that done up front. And then once the deal comes up, we are much more confident about our ability to close. We can be much more aggressive with our offers. We're not out there like making cash offers, but if it does make sense in some instances, there's the capital's available. That might be an option, and if that's what it takes sometimes to win a really good deal, that would be the case. But for the most part, it's usually non-cash, but we feel very strong about it, primarily due to the fact that capital backing is there. And then obviously our operations and teams and our due diligence, we're ready to do whatever it takes to make sure it's a good deal and then get it to the finish line from there.
Yeah, no, absolutely. I have another friend who she's starting a fund too, and her whole purpose was to basically see a property she likes and say, all right, I like it. Here's $1 million hard day one, and I mean, no one's going to turn down an offer where they're getting $1 million no matter what. So having that money on hand for those of you who aren't operators, who aren't investors, who want to participate with guys like us, having that money on hand for us, it actually creates a lot of value for the investor because now we can even produce higher returns because we're usually able to buy a property for more of a discount. A lot of big issues and question marks in this space is, well, the biggest one is, can this guy close? Even if this guy's closed 5, 10, 15, 20 deals and he is a syndicator, operator, whatever, if it's someone who's always having to raise money or rely on banks, especially the first couple of times, you don't know if someone's going to close. And oftentimes sellers, they like a cushion, they like an insurance policy of that earnest money. So having the money on hand ready to go it's awesome. You can come in and say, hey, we got money lined up. Do you want to sell your property, or do Do you want to wait around with this guy for 90 days, or do you want us to close you out and write you a big old check in 30?
Yep. 100%, man. And we typically we would avoid a lot of the upfront costs, like the deal costs out of the fund itself. We would front it ourselves as far as like earnest money, due diligence, all that good stuff. Uh, Primarily because we don't want to put that is what I consider that like high risk.
Yeah.
But all that, and so we would typically put the fund into the closing and into the equity piece. We would self fund the kind of miscellaneous costs that you're going to have during the deal, whether it's the earnest money being sent in, whether it is due diligence costs, and a lot of it is recouped at closing. But in the event we don't close, we don't want to risk the investors' funds that are in the investment fund in itself. However, just the sheer ability to close on anything that we make an offer on is actually a very strong statement, and it speaks well, especially with brokers in the commercial world. When we're looking at 50, 60, 100, 200 units, brokers typically want experienced buyers or buyers that are ready to move quickly. They're much more selective about the buyer base. And so the ability to have that backing, say, hey, we're ready to close at any point, speaks volumes to whether it's brokers, whether it's sophisticated sellers that have been around that really want a well-qualified buyer. And so that's what that's what the fund helps us do.
No, absolutely. I mean, yeah, these are 5, 10, 20, $50 million assets, and there's not many Joe Blows walking around the street that have that much money or have the ability to borrow that much money from a bank. So yeah, it takes a high level of sophistication and a high level person to do what it is that you and I do. And I don't say that in a cocky way; it's just straightforward. There's a lot of risk involved, but there's also a lot of rewards. That's why we do it.
Yep.
So let's see. I mean, how did you get started? How did you get started in this space? What made you want to get going in this space specifically?
Yeah, man. I mean, I've been in real estate for over 5 years now. It's crazy how things snowball once you get started, and once you've got the intent to grow and develop and push and get better, things just start to snowball. And especially in real estate, there's so much opportunity, um, whether it's on a deal basis, whether it is like a niche, a specific opportunity that pops up, whether it's in the brokerage world, in the management world, in the development, construction, syndications world, kind of what we're doing. There are so many different ways to play the game of real estate and to be active in this space, or be passive but be invested in this space. For me, it started off as a brokerage, right? And so I called up a broker and I'm like, hey man, I've got, at the time I was a junior in college, and I'm like, I've got like $5,000 to my name. I want to buy a rental property. And we're in Cleveland. He makes a joke about, I'd be buying in a rough neighborhood. I probably will never get the rent, and just make something out of it. But he suggested, hey, you're a young cat. You're obviously interested in the space. I like your drive. How about you come get licensed, kind of learn the business from the ground up as an agent, right? And so that's how it started. Became an agent, Cleveland market in the 2016, 2017, probably from the get-go, from the 2016, from the time I got into it, there was tons of out-of-state investments happening in our market. There was a lot of California money, a lot of Texas money, a lot of New York money going into properties here because we have very low purchase prices. We have a low entry point. And so you have a lot of buyers that come in for turnkey purchases. They want to buy single family homes for, at the time, 50, 60 grand that you can rent out for $900, right? And so it's certainly an attractive market. And having grown up and lived in many different neighborhoods in Cleveland, I was able to pick up and help out a lot of people because I just simply knew the area. I knew the market. I knew kind of what rents were for because we kind of rented all across in different neighborhoods, the tenant profile, all that good stuff. And so it kind of came out naturally. And it started off, I'd be selling property out of my, marketing class in college. And then it transitioned into, hey, a year later, I've got a broken XYZ or I've got a damaged roof. I know you're on the ground, you're flipping some properties. Can you help me out? And so we started doing renovations for these guys. We eventually started our management firm. We opened up the brokerage. And from there, that's really where the growth started taking place, right? 22, 23-year-old, never been a manager, never held like a leadership position. Now all of a sudden I've got to hire people, bring on help, build systems, develop other leaders that can lead and help others improve in the company. And so this is all, probably 10 years worth of learning and experience crunched into like two, right? Because there are so many moving parts and pieces at the same time. Now, mind you, I was doing like 80, 90, 100-hour weeks every single week. But essentially being able to cram that all, think about it, you've got a construction division going, you've got a property management firm you're building up, you're a broker, you've got agents in the office, you've got a couple hundred tenants that are calling you at all times. So we had to learn, and we had to learn quickly, right? And so that was the get-go. And once we figured out how to build a system, once we figured out how to build good, culture and pass along some of our values and work ethics to the team members that we bring on, that's where it really started to snowball for us. So we've been able to transition into multiple businesses. You mentioned, we're in the cabinet space. We're getting in there. We've got a flipping company. We've got the fund and the real estate apartments businesses. And so all of that branched out of kind of being able to figure it out at first on a broker residential model, and then kind of scaling up from there, getting better at dealing with contractors, dealing with people, tenants, building systems. And so, once you've built a management company, you kind of know based off of a few small metrics, if this number went down, whether it's like applications. Well, now we know if applications are down, whether they're not showing enough, or we're overpriced, or the condition isn't quite there, possibly the leasing agent isn't doing their job. And so some of these minor things you start to pick up on when you've had the experience to have to build it from scratch, it helps us a ton in what we're doing today. And so, it just keeps growing. It keeps the investor relationships keep getting better. The team gets stronger and better, more experience for everybody. And so, we're excited about where we're going, but that's kind of where we came from. That's where we started. And it all builds off of one another. Every year has been built off of what it was like the year before, and the lessons learned the year before, and then just making progress day by day. That's the name of it, man. 1% better every day, and that's how that's why we are where we are.
Dude, absolutely. And no, man, I really, I do that step by step because seriously, he was saying it. And guys, I really love what Jad's doing, man. He's a great dude. I keep saying it over and over. He's definitely a homie of mine, a brother I consider. The way him and I met is we actually, we're two of the youngest guys in this room. It's a mastermind put on by an absolute stud named Tim Bratz, with two different colored eyes. The guy's cool. He's got two different colored eyes. I was like, what's going on here?
Yep.
I noticed. I was like, what? You're a creature. But anyways, no. Guy's an absolute stud. He put this mastermind group together, and I'm not sure exactly how I got in the room, to be quite honest with you guys. I had a business partner at the time that they sent the invite to both of us. We put our money down, and dude, getting in a room like that with guys like Jad, guys like everyone else in that room, which are going to be on this podcast as well, it's incredible. Hearing Jad's story, it really it lit a fire in me, man. Seriously, like because personally I'm an agent. I have a partner in that. We're slowly kind of building a team, but really focused on building up and buying our own properties to fix, flip, and sell. And then also, I also syndicate with Jad, like Jad as well. We had one deal together; it didn't quite go through, but we're definitely gonna do some more in the future here. But no, man, it's a true testament of hustle, of focus, and grit. I mean, seriously, you guys heard his story. He started off as a junior in college, trying to buy a property with $5,000. That's awesome, man. Actually, I kind of have a similar story that got me into multifamily. I want to share it because it's very similar to yours.
I'd love to hear it, dude.
My junior year in college, I started hearing about multifamily. I started hearing about Grant Cardone, that guy. And I clicked on one of his ads, and I got spammed with him every single day, and it just kept, it kept obsessing in my head, like multifamily. And then I saw that he created this non-accredited fund for non-accredited investors, and it was like the minimum is $5,000, and I was like, and this is the first time I raised money. So I called two of my buddies because I had like 2,000. I called one friend, he had another 2,000. I called another friend who had 1,000. Surprisingly, I was like, "Hey, we're gonna be investors in an apartment complex." They're like, "What?" So we took our 5K together and we gave it to Grant Cardone, and we have made no money on it. But it was that was what turned me on to multifamily. We made like 10%, 5-10% a year. It's usually like 7,
Yeah. Yeah.
but no, I mean, as far as multifamily, the idea for me as well. It started in college, and it became this just obsession of how to get to that. How do I get from here to there? So, you know, just like you, to learn the business, I got my license. Within a year of getting my license, started wholesaling, started looking to flip houses, stumbled upon Tim Brotz's course, learned how to take down multifamily. I mean, it's that focus, man. It's that obsession that just, if you're focused on getting to here, there's going to be walls, but you just keep breaking down more walls, and then it just opens up for you. You know, it's
That's it, man. It's like kind of figuring it out every single day, just showing up every day and doing something, taking some sort of action to get better. And some days it doesn't. Some days you just feel like you're stuck in one spot all day, and you're in your head all day, and you can't really get past this wall that you're punching up against, right? But it's showing back up tomorrow and trying again, and maybe the next day you have a more clear head and clear consciousness, and you've got your head and your thoughts are flowing much more creatively, and then boom, like you could be driving home that night, and then an idea comes up. You're like, oh man, I've been stressing about this for 2 days, and we just solved it. Or here's what we're gonna do, right? And you just get back up, you show up the next day, and get after it. And so that's what it's all about, man. You mentioned Grant, dude. I mean, this guy inspired a lot of what I do. I because I admire his drive at his age, but not all that. Also the marketing piece, right? I think he's got something great going there on the marketing side. Yeah, I think his plays maybe are a bit less cash flow heavy, maybe a little bit longer term hold, and you make a big buck at sale.
There's a lot more fees.
That's part of it, but I think his model is more so you're buying really safe assets already in top tier markets, very attractive markets. So you're going to make less return, but at the same time, that's probably as safe as it gets in terms of buying an already stable asset, right? And so I get the model. We like to make a little more returns on our money. I think we're in growth phase, so we take on more value add. We take on more, projects that we've got to go in and put some work on, and they're not already pretty. They're not already 300 units in whatever Orlando or wherever he's buying, right? But essentially through work, through renovations, through improvements, through better management systems, we're able to really push the value up, and that helps us and our investors kind of do much better. So,
I mean, Grant's assets, they make sense to buy if you've got like 1 to 10 million to put, because when you're making 5 to 7% on 1 million, that's 5 to 700. Well, that's on a million. What is that? Is that 50 or 500?
5 to 7%, you're doing anywhere between 50 to 70 G's a year on the $1 million.
Yeah. So I mean that makes complete sense, because that's enough for someone to live off of. Someone who just retired from their job, take their IRA and put it in that. It makes a lot of sense, and it's very secure. Yeah, for someone looking to invest 100, 200, even if you have a million, you want to make higher returns. That's where the value add play is not to sound corny, but much more value, because you're making around. I mean, Jad said it. We only target deals that we can make a 19% return on, 19% a year. So do the math, and it's a lot sexier return.
I'm a obviously much bigger fan, and of course we're everybody's biased to their own model, but I'm much more of a fan of like, hey, let's buy this thing at way under market value. Other syndicators, they're buying them at market, and nobody can tell where the market's going. But if things go sideways, you don't know if the value it will be there in 5 years, right? Maybe you have to hold it for 10 years plus. Some of the assets that are bought at the top of the market at premium prices, you might have to hold for a very long time until the prices recoup, right? And so I do like the fact that, our strategy, and I know what you're buying in similar ways. It's like, how do we get value from the get-go? How do we buy below market value so that we're able to, from day one, if we have to fire sale it, we can sell it for more than we got it for. However, the intent is not to. The intent is let's improve it, let's go to the bank, and then let's hold it long term and just cash flow, right? Build generational wealth through owning assets that we've done the work on, we've renovated, so we know they're in good shape,
Yeah.
and then just continue to holding cash flow on them for years to come.
No, yeah, and that's it is it's a big hedge against inflation, buying below market value, and even if it's below market value, but my big thing is I'm looking at what's it valued at now based on the money it's producing. So something that's been happening lately, and not lately, it's been happening for a while, is people aren't even selling on cap rates anymore. A lot of brokers, a lot of big institutional money, not all of them, but some of them, they'll just buy off of price per door or comparable price per door. It's like you look at an A-class property that's producing a 2% return with a 2% cap, and you're only buying it because the thing next door sold for the same, but that thing's actually making a 6 to 7% return. So yeah, no, I definitely agree. Cash flow is king. As the shirt says, that's why we buy these assets, because it's a home for people. It's a home, number one. Number two, to live in that home, they pay you rent, and whenever they pay you rent, that goes to you because you own the property. So yeah, I think people get lost in translation sometimes and just try to bet on appreciation. Appreciation is absolutely great. That's what has caused real estate to be the most recession-proof asset. But to only bet that if I buy it for $1 today, it's going to rise to $1.50 in 2 years, 5 years. That's not what we're in the business of doing.
Yeah. I mean, we're all everybody wants a better quality of life, right? And so if we're all in it just for appreciation, we really only experience it once we sell and then we have a bunch of cash. The sweet thing about commercial properties and multifamily specifically, and just cash flow in general, every single month there's a drip of cash flow coming in, some sort of passive, or for us it's active income that's coming in that's just about guaranteed. I mean, even in like the worst times in like COVID and everybody's expecting these 30%, 40% of people are going to move out and can't pay their rent, which was not the case. It was much better than that. Even in some of the worst times, there's rent coming in at the end of the month. There's payments coming in at the end of the month. It's still a sustainable business model. People will always need a place to live, right? And so, the cash flow piece is the big driver. The appreciation is awesome because then we can sell, move into another one, park more capital, all the gains that we roll it on to the next project and then more. However, I think the big piece here is every single month there's some sort of distribution, there's some sort of cash flow coming in, and that's a great business model and a great way to support any lifestyle you want to live. So that's the name of the game for us, right? It's cash flow. It's building long term healthy returns, and it's something to support. It's not just the money, dude. It's you want to be able to live. You're in real estate. You want to be passive. You want to be able to live where you want, go where you want. Be able to spend or give back or contribute or use your money for good. You can do that by having sustainable, consistent streams of revenues, whether it's multiple properties, whether it's businesses, whatever it is that brings in cash and brings in some sort of stream of income for you at the end of the day. So that's a big that's the name of the game for us. Appreciation is sweet, but I'm in it for the monthly nut that comes in every day.
Oh yeah, no, I mean, and that's huge, man, because like you said, cash flow provides you freedom. That's the reason why we all do it. People think that a lot of wealthy people are money hungry. They're not. Usually, money's a resource. Money's the resource. Currency is the resource in order to buy food, buy travel, live in
Yep.
shelter. So, being able to initially, most of us have to trade our time for it. But then once we have enough of it, our goal is to invest it and help others invest it in these assets that produce them enough incomes that they don't have eventually, whenever they decide, that income that the asset's producing causes them not to have to trade their time for money anymore, and allows them to, like you said, do more travel, good things. If you just want to bake all day, if you want to go to the gym all day, which is what I want to do, just be a big old tool. I'm kidding, but no, your time is the most valuable asset, and I think the reason why you and I both got in this is to make the most of our time that we're here and protect our time, because we don't
Yep.
want to be in an office hammering the phone all day till we're 40. That's just I'm not, I better be a billionaire by that point, and still I'll still be doing this all day,
Yep. Yep.
no matter what I'm selling. So yeah, but
Yeah, man. And I heard it somewhere, and it always stuck with me. Money is the best tool for the transactions that it does, right? And so that's really all it is. It's not like you get a street creds. Like, yeah, there's some sort of social things behind it, but that's all fluffy. That's not real. There's nothing sustainable there. It's mainly a tool to fuel a better life. So, if that's what you're going for, financial freedom is just a piece of the puzzle, which is the total freedom, the time freedom, the expressing yourself at another level through using your time how you want, through being able to connect, being able to go places, being able to see things, and just experiencing life at a whole nother level. I think that's much more important than the numbers in the bank account and all that, the digits that come in.
I mean, fast cars are cool too, but no, I'm kidding. No, your time is your most valuable thing, and I had a really good conversation with one of the guys in our group. His name's Yaden, and you know he said something like this. He said, if you ever feel guilty, no, he said, what we do is very special. He told me this story. I'm gonna tell it real quick. He had this guy who was 73. He was 73. He was driving Uber. He was working for Walmart. He had his IRA, but it wasn't making him enough to live on. He took that money and invested into one of Yaden's deals. He took $1 million, invested into his deal, was paying a 10% preferred return, which is double what he was making driving Uber and working at Walmart. This guy's 73.
Yeah.
And, when he did that and started getting out these preferred return payments, he called up, he was almost in tears. He's like, dude, I'm able to retire now. I'm making $100,000 a year from all this money I have and I've saved up. And I'm able to retire. Like I can, this is incredible. So, and the kicker on that story was that was his dad. That was
Wow.
that was his father, dude. Like that was, and that got me a little teared up, man, because I do I'm very close to my father, and it's an incredible thing, man. It's an incredible thing, to be able to know how to manage and run these assets and provide people that lifestyle, be able to help people not have to trade their time for money anymore. So I want to share that real quick, but
Sorry, man. I actually didn't know that. That's really cool. That's because I'm in a similar spot, right? I have family members that are in the companies that work with me, and it's one of the coolest and the best feelings to be able to provide some sort of in some one way or another, right? And just to be able to, through what they're doing, be able to help his dad kind of retire, or maybe something he maybe didn't think he could do at his age, or he had to keep working or doing Uber or whatever else he's got going on. Maybe that wasn't even a thought of like, oh, I'm able to retire. And so that's cool. That's powerful. That's a big piece of that is actually what drives us, right? So I got into this space for that same reason. It's like, the flexibility and the lifestyle and being able to not be tied down to a 9 to 5. And my goal is like everybody that I talk to, every investor that comes around and talks to us, wants to be in our fund or one of our deals, or just wants to buy a single home, for instance, that he wants us to manage, telling them all the time, like, dude, this is a 20-year game for us. I'm not interested in like knowing you for a year. I want to see you 20 years from now retired, and all of us are just hanging out talking about what we did, what we're doing, and what we've got in the works at that point, and how we're spending our time. That is a big driver, because obviously, yeah, there's good things of growing the fund and the business and having all that good stuff. But I think a big piece of it is like relationships and people and the impact that can do. So through the power of what we do, many people can benefit. It's a win-win. So it's just, that piece is exciting. I did not know Yaden's dad was the person in the story, but now knowing that, that's pretty cool. That's powerful.
dude, it was, man. It was really powerful because I struggled on a couple deals, a couple capital raises, and I think it's because it's almost like the commission breath. They tell you as a salesman, don't have commission breath, and it's like hearing that and going through the trials I went through is kind of like, wait, let's take a step back, realize how much value you're providing. Realize that value and own it. And people, it's almost like when you smile, the world smiles back. When you exhibit an energy, that energy is attracted to you, and people can feel it. So So that story is really powerful for me. The guy you told is absolutely crushing it right now. I mean, they I think they own close to 1,000 doors. His partner just bought a Ferrari, even though we're not talking about tangible things. He bought a Ferrari. I think it's pretty cool. I like Ferraris, but
Just a little guy.
oh yeah, what's up, kitty cat?
Um, you know what, man? I was actually on there. We were doing an interview the other day with Jennings, Gideon's cousin,
Oh,
and we were talking about similar stuff. And I love what they're doing because there's a lot of impact there, not only for obviously their own deals, but what they're doing with their platform, and they're able to teach a lot of people what they do and how to do it. So there's just so much power in this. And again, there's so much opportunity. You could be an agent, a broker, a management company, a contractor, a flipper, a syndicator, somebody who's teaching how to do this stuff. You could be an Airbnb. I mean, there are so many ways to play in this space. But I think the long-term piece, no matter how and what you do, I think a lot of people gravitate eventually towards how do we put our cash to use, or to be deployed somewhere, and then have some sort of recurring revenue come in. So again, dude, it's the name of the game 100%, but it drives the retirement for his dad. It drives like us having this conversation and not having to be working a 9 to 5 or whatever it is that we're doing, right? And so it just fuels so much more than that essentially you're able to have the flexibility and the ability to do what you want when you want. And so it's such a powerful tool, man. I think obviously we're very niched in real estate, and of course we lean towards real estate. But anytime you're investing, whether it's in yourself, whether it's in some sort of good opportunities long term, the name of the game is how do we free up ourselves through investing, whether it's our time now so that we work less tomorrow, whether it's our capital now so that we work less tomorrow, just investing in your future so that tomorrow is a little bit better than today, and the day after that, the day after that. That's growth, man. That's what drives us. If we're gonna be flat forever, I don't think we'd be motivated. And so there's a big driver in it, and across the board. I know we talk cash flow and capital and real estate all the time, money, but they're just growth in general. The guys that go to the gym, they're not excited about being flat in the same size their whole life. It's like they're seeing progress and they're more excited, whether it's like growing or whether it's the opposite, shrinking and trying to cut weight. So progress, improvement, growth, and that's financially, that's physically, that's health, that's mindset, that's your family. I think that's the name of the game for me. It's always like the driver to get better, and that does that brings more of this. It brings more health. It brings more everything.
And some finishing thoughts. What would you to that young guy who's a junior in college? What would you tell him right now? What advice would you give him?
So if it were me, I would I think I've had a great run. I wouldn't change anything if it was like to myself in back in the college days. To anybody else, to any 20-year-old, 21-year-old who's just getting the game, whether it's like whether it's in the real estate space or something else, just start investing in your future. Take action to build something on your own. Don't necessarily. I'm not a fan of the whole 9 to 5. I'm not a fan of, like, for some people that's the right way to do it, but I'm not a fan of only being in a 9 to 5. Like, okay, do your 9 to 5. Then if you want to start something on the side, cool. If not, no problem. Do your 9 to 5, invest your cash somewhere that can get some sort of return so that in 10 years you can go 9 to 2, 9 to 1. And then eventually 20 years later, you don't have to work at all. Right. And so that's probably the only thing I would say. Just like get started sooner, start figuring out how you're going to get your finances together from an early age. Cause like, dude, we're young, we're in our early 20s, or we were a few years ago. There's a lot of temptations and there's a lot of fun and partying and all that good stuff. And it's cool and it's exciting, but it doesn't last forever. There's something more to it than that. There's something that's coming ahead plan for. So the earlier you start, the better. It's really the best way to go about it. Yeah, it's just getting in earlier, starting earlier is probably the best thing I would say.
Absolutely. Well, all you guys, thank you for hanging out with us. This episode will be on YouTube, so check it out, and I'll leave Jad's contact in the description as well. All right.